Thank you very much for inviting me to this conference to discuss this very impressive paper. This is a very substantial piece of work, a long paper, but also I think a very interesting paper you can spend a lot of time with if you want to. So this is a paper that belongs to the bigger initiative of the IMF of thinking about what is called the IPF, or the Integrated Policy Framework. And very superficially, I could say that's a big initiative to bring policy from policy analysis in the academic sense a little bit outside of just having for monetary policy, say, just one instrument, namely the nominal interest rate, but thinking here very seriously about a large number of instruments that are actually used by emerging countries and trying to understand why that might be so and why they are desirable to be used. When you have many policy instruments and many frictions, I think you can basically make a decision. I'm going to have a quantitative infinite horizon model and I solve it numerically, or you can go another way and say, I'm going to try to do something analytically. I might have just a 3-period model and I can get some analytical expressions and understand what is going on. And the paper I'm discussing belongs to the second group. So this is mainly an analytical paper. So the framework is on purpose held simple to resolve the trade-off between results and quantitative results a little bit more on the understanding side. So this is 3 periods. It's a nonlinear small open economy. And the ingredients that are put in, I think, are carefully chosen to illuminate the question at hand. So there's the classic sticky price friction. That's the T sector, the traded goods sector. So it is assumed that the small open economy has market power in the entire world in setting its price. And then 2 cases are considered, that the sticky price is either in a foreign currency or in the domestic currency. And then there's a non-traded sector, which has flexible prices. Here, I think Suman didn't talk much about that, but the non-traded sector in their model is the housing sector. So that's assumed to be a flexible price sector. And then there's a pure wealth effect. There's a commodity endowment, prices are flexible, and we just saw an illustration about what happens if there's a wealth effect from a permanent commodity price shock. Why is this framework one where you have to think about, or there's room to think about various different policy instruments? There are quite some frictions. So there's the normal price rigidity for the traded goods prices. There are a lot of financial frictions, and there are 2 collateral constraints. And then the foreign exchange market is segmented. That's a way to get UIP shocks. There are 2 bonds. There are 1-period bonds. One is in domestic currency, the other is in foreign currency or in dollars. Domestic agents only trade in domestic currency bonds, and these financial intermediaries are needed, or the government is needed, to make the link to the world capital market through foreign currency bonds. The paper is interested in the setting of 5 policy instruments. There's the capital control tax, FITI, the policy interest rate, so the federal funds rate, say, IT. There are taxes on loans from the domestic bank to the private household, that is called theta HH. And then there are taxes on loans from the domestic banking system to the non-tradable sector, which is called R, like real estate sector. And the real estate sector, again, has 2 subgroups, and there's one with a linear production function. Those ones also get taxed. And then the government has a chance to do FX interventions. That's the 5th instrument. That instrument cannot be used completely freely, because I think that model would have a feature, or at least one can speculate that this model has a feature, that if the government could completely freely use this FX intervention, it could fully circumvent the financial friction, in the intermediation friction, and just do borrowing directly from foreign lenders and make a lump sum transfers to the household. So there's some limits to how much the government can use FX interventions. And I think it's rightly so, because after all, we don't think that the government is the best to allocate credit. And then, at least in the version of the paper that I saw as exogenous shocks, one which is called a UIP shock, or they don't use the word UIP shock, they call it a foreign appetite for domestic currency debt shock. This is the ST that Suman just showed. And then there were shocks to leverage the collateral constraints we'll see in a moment. They have these kappas, and they discuss these kappa shocks. How is the analysis in the paper structured? They characterize optimal policy of these 5 instruments under commitment. There's very impressive, very detailed analytical work. The paper has 5 propositions. And then in the end, there's some numerical illustration. So let me use this graph that Suman just showed you maybe to explain a little bit where the frictions are here and how they motivate the various policy instruments. So there's a domestic bank, and the domestic bank takes deposits. They have to pay IT on their deposits. Yellow means it's a policy instrument set by the domestic government. So the government sets the federal funds rate in that country, and the bank lends at the interest rate rho T. The bank is constrained. The total amount of loans it can make, D, is limited by assumption by this constraint. And since this price is set, this is a sort of a limit on the total volume of lending. Another friction in that, or a policy instrument in this economy, is that if the household takes a loan from the bank, then it doesn't just have to pay the bank the interest rate rho, but the government can put its fingers in the middle and also collect this tau HH, this macroprudential tax. Similarly, for the housing sector has 2 subsectors, a nonlinear and a linear one. The linear production function one, the one with the linear production function, is subject to a stock collateral constraint that gives rise to a pecuniary externality. Why? Because the price of houses enters here Q. So we know if there's a pecuniary externality, that one way of addressing that sometimes is to use a tax on the interest rate. So there's this theta L here. L means land, and the government can pick this. So these are 1, 2, 3 policy instruments. The 4th one comes from the UIP friction. So here, the paper doesn't just put an ad hoc UIP friction. They give a little bit more structure to that, following the work of Gabaix and Majore. And in this UIP friction, there's the capital control tax FITI. And so what will this be used to? This might be helping the country not to hit its borrowing constraint. And then the 5th element is that the government can completely, if it wants, bypass the financial intermediary, not completely, to some extent, by doing foreign exchange interventions. And as I said before, I think in the paper it is assumed that there's a limit to this. Otherwise, it seems to me that one way to go would be to use this foreign exchange intervention and finance them with lump sum transfers or lump sum subsidies. Okay, so you might look at this and you think, oh, this is very complicated. So why do these authors go down this road? Can't we just do one friction and one policy instrument at a time? And I think the motivation is there's really a big need to have some integrated policy framework to analyze this. So all I'm going to do is I'm just going to give you one example. Suppose I take a model, infinite horizon model, and I have one policy instrument, a capital control tax. I have the identical 2 shock stochastic processes in that environment. A trade and endowment shock and a country interest rate shock. It's a bivariate, so it's a bivariate AR1 shock. And the question is, what is the optimal capital control policy? Is it pro-cyclical? That means, do I raise the capital control taxes during a boom so that I don't have so much capital inflows? And I lower it during a bust so that I help the country when something bad happens to borrow from abroad, which is usually the insurance theme we think about when we think about the intertemporal approach to the current account. So what is the cyclical properties of optimal capital control policies? And the answer is there is no just, yes, it has to be always pro-cyclical or always counter-cyclical. It depends on many aspects of the model. So here I want to have one illustration where I show you how it depends on the friction in the model. So I'm going to consider two models. One in which there is a combination of a normal friction, downward normal wage rigidity, and there's a currency peg. And I'm going to oh, this is it. Okay, so I'm going to also take 1 or 2 more minutes. You can show that in this case, the optimal capital control tax is pro-cyclical. If on the other hand, you throw out that friction and you put in a flow collateral constraint a la Bianchi, you can show that the optimal capital control tax is counter-cyclical. So I'm going to use my last minute to give some intuition why, and also tell you if you were to put both in. So on the left-hand side, it shows you a boom-bust cycle in the exogenous variables. ABO goes up and then goes down, and the interest rate. These countries have the phenomenon of when it rains, it pours. Good YT typically means also good news on the interest rate at which the country can borrow. And the bottom graph shows you with a broken line what is the optimal capital control tax. The intuition in that particular case for why the capital control tax is pro-cyclical is that during good times, you want to stop the capital inflows so that they don't drive up prices so much, they don't appreciate the real exchange rate so much that when the bust comes, you don't know how to get the real exchange rate down. So that's the reason why that model would say optimal capital control taxes are pro-cyclical. If you go to a Bianchi type of specification without any of the monetary frictions, you just have a collateral constraint, you have a pecuniary externality here. And the problem is that the economy would love to borrow a lot. They're impatient. They would love to be very close to the borrowing constraint, but not at it. And since there's a pecuniary externality, households sort of misjudge how close they are. And so then they need help from the government. So during the boom, there's no need to have a lot of capital controls. So capital controls falls. But then during the bust, the pecuniary externality makes you miss the point how close you're to the binding collateral constraint, and the government sort of needs to help the private sector by raising capital controls. So you get the opposite result. So you see one friction or one model at a time, you get opposite results. That shows you there's a big need to have an integrated framework. And let me just say one more sentence. In that particular setup, if you put both of these frictions in, and then you ask how should capital controls behave, it goes with the left-hand side. It goes with pro-cyclical because the frictions introduced from the normal rigidity here generate unemployment, and that seems to be the completely dominating force. Okay, sorry, I went a little bit longer, but it's a very substantial and interesting paper.
Thank you very much, Stephanie. While we wait for some questions from the audience, perhaps Suman or some of his co-authors may want to do a first quick reply. Stephanie?
Yes, just to say, firstly, a very thanks so much to Stephanie for, it is a long paper, and we appreciate the explaining the elements of how the model works, actually more than I did in my quick time, looking at the diagram, exactly how the frictions are related to the different stages. I think that indeed this is what really motivated us to do this overall framework, to try to see how these things could interact with the set of frictions that are relevant for emerging markets. And at the beginning, there were several results that could have gone in different directions, and I'll mention a couple. So one is the benefit of exchange rate flexibility under dominant currency pricing, which interacts with the tightness of external constraints, which may be motivated by by sharp depreciations. So these two things are connected, and when you have less of an effect of the exchange rate on the external sector, that could be an argument for more or less exchange rate flexibility. But it does really matter what are the instruments. So what are the margins that the planner is trying to address, and what are the costs of moving the exchange rate. If the costs are equally, if the cost just follows something like a reduced form quadratic cost, then you would have to have more destabilization. Then you may hesitate to move the exchange rate a lot when it has very little benefit. But when you are not in the zone of, if you try and microfound, there's use the insights that are in the literature, you may get the costs arising when the external constraint is binding, but not before. So in normal times, you might have more exchange rate flexibility under a dominant currency pricing until you hit the external constraint. And then that's the argument. Exactly that point is when you have the capital controls ex ante. And another case is, of course, as I mentioned, the connection between FX mismatch regulations and FX market depth. And I think that this is something that that is the subject of many policy questions and needs to be resolved more as well, because sometimes the regulations that you put in order to reduce the susceptibility to sudden stops do affect the functioning of FX markets and the composition of the investors in the FX markets and the premia that you get on the domestic currency debt, which is what you're trying to get people to substitute to away from the FX debt. But the way that you do that, induce that substitution, the regulations would affect the premia too. On the FX intervention, indeed, I would say 2 points. One is that, yes, you can impose some kind of limits, as we sometimes do on the paper, to try and make sure that the government doesn't intermediate fully. In addition, even when you allow the government to intermediate fully, in some cases it does not, because it is trying to earn some carry profits. So it does want to have an open external position, and that desire for carry profits also leads them to do a lean against the wind tendency. So both the consumption stabilization and the carry profit motive help induce the central bank to lean against the wind. The second of them induces them to have a little bit of an open position and not intermediate everything. So I would say that for now. And is there any? So thanks so much, Stephanie. And is there any other questions I'm willing to answer?
Yes, there's a question by Ambrogio Cesabianchi.
Thank you, and thank you so much for the very nice presentation, and to Stephanie for the discussion. My question is about the equivalence, if any, between macroprudential measures and capital controls. And sorry if I missed that in your presentation, Suman, but I was wondering whether you guys have looked into, any equivalence between using, for given model and frictions, whether you could achieve the same allocations by moving domestic macro policies or capital controls. And if that's not the case, what are the levers that don't allow you to, to achieve the same allocations, if you see what I mean?
Yeah. Should I answer, or should I collect more questions? Okay, well, let me answer. Yeah, so I could say maybe 2 steps in the answer. The first is that we do explore in the paper, just in the very simple model, without adding the housing sector. Just you've got one straight line of funds going from foreign sources to the domestic households. If it really is very simple, just one straight line, they're perfect substitutes. In the funds terminology, the macroprudential measures would still be classified as CFM capital flow measures / macroprudential measures, because they are seeking to influence the level of inflows in order to affect domestic credit conditions. So, but yes, there would be perfect substitutes. Now, if there are sectors that can evade some of the macroprudential restrictions, then of course that there's an environment where even if there's some cost, you would want to put some additional instruments in order to complement the capital control, the macroprudential restrictions. They may not work perfectly unless you also have complementary capital controls. There's also another environment when you introduce the housing sector, then the perfect equivalence. So even ignoring circumvention, you may not have a perfect equivalence anymore. And we deal with this a little bit more in the paper, because what can happen is suppose in a sudden stop, the nature of the crisis you face removes certain instruments from the mix. So for example, if you have a sudden stop, you're no longer able to use capital controls exposed. You can use the housing macroprudential measures exposed, but the capital controls won't work because that margin is already not effective. So that will affect your ex ante decision of capital controls too. And in the reverse sense, if you don't have an external constraint, but you have a domestic constraint, that the housing macroprudential taxes can no longer be used ex post, and that affects the optimal level of the ex-ante instrument. So the longer answer, when you have the domestic and external constraints, and you have shocks that can make some of them binding, the equivalence can be broken.
Suman, I don't see any more questions, but actually I have one. If so, I mean, I fully appreciate the as Stephanie well put it, the necessary complexity of the model, right? Because the whole point is to integrate several dimensions of the problem in order to give some framework for the different needs that arise in the very heterogeneous countries, right? That that the IMF represents. But I have one issue that I would like to hear your thoughts about, which is, if I understand correctly, in your model, there are some, I guess, deep parameters that describe the depth of financial markets, and depending on these parameters, some policies might make more or less sense. So, for example, whether there is deep markets for hedging, right, exchange rate risk. In practice, though, some of these parameters might well be endogenous to some of the choices that countries face. So we have a paper on this we published in the last conference of the bank with Governor Marcel and also some people from the IMF. And there we show some empirical evidence which supports the view that when you don't have policies such as currency interventions, that itself incentivizes countries to, or no country, the private sector, to seek out their own, to develop their own markets. So I'm not asking for this to be in the model or anything. I'm just would like to hear your views on whether you think this is an important issue, something that you guys are discussing. Yeah, that's my question, I guess. Thanks.
We do believe it's an important issue, and we believe that that in general, you do want to show how government policy can affect these deep parameters over time. So it's like we do take some parameters as given, and then we take like the balance sheet constraint for the international intermediaries, which could over time develop as new people enter the market, the cost of FX hedging, these kinds of things. What we view is our paper, by integrating these frictions, shows what happens a bit at the business cycle level. So what happens to these different prices when you have shocks in this set of frictions, and then that hopefully should be connected to what happens in the future too, in terms of the development. So basically, we hope that the model can provide an intermediary step towards that bigger discussion by integrating more of these frictions. So, for example, if you say that there is a policy that, let's consider a case of the FX mismatch regulations, that we may think that it might, in the business cycle frequency, maybe make the country a little bit more subject to the foreign appetite shocks if the market is already shallow to begin with. But then it's exactly, we're showing that there are more volatile premia on domestic currency debt. And so those premia might induce other people to enter. So then that's where the next step model would then come in, right? So how much do the premia induce people to enter? And that would then depend on which shocks the premia is also being caused by. So if it's being caused by shocks that can be in principle insured and there are few externalities, then those are the kinds of shocks where you expect the market to be doing something. If the premia has been generated by shocks where there are lots of externalities that are not internalized, then you may not expect that the people would actually want to pay the cost of the hedging against those kinds of shocks. So they might not want to enter because they won't get the premium, they won't get the private return. And in that case, you need a little bit more government intervention. So basically, our model provides a little bit of an idea of thinking which kinds of shocks lead to these these different premia, these different price signals in the context of multiple frictions, which you then can use to think about which things would the market remedy, which things the government has to remedy.
Great. Thank you very much, Suman. I think we are approaching time. Maybe we have 1 or 2 minutes left, but I don't see any more questions here. So perhaps let's end the session here and give some time to our last 2 speakers of this conference to get things set up. We will now have the session, including the long-awaited keynote speech by Carmen Reinhardt, and then some concluding remarks by Sebnem Kalenioskan, which is a co-organizer of the conference.
Thank you very much.